In the fall of 1949, a businessman named Frank McNamara sat down for dinner at Major's Cabin Grill in Midtown Manhattan. He had a client across the table, a waiter approaching with the check, and a problem. He had left his wallet at home. His wife had to come rescue him with cash, and the whole thing was embarrassing enough that most people would have just laughed it off and moved on. Frank McNamara did not move on. That dinner humiliated him. And that humiliation would end up creating a product used by more than 500 million people worldwide. A product that would generate trillions of dollars in transactions every single year and, fundamentally, change the relationship between people and their money. That was 1949. By 2024, total credit card debt in the United States alone had crossed $1.14 trillion. And the average American household owed more than $10,000 on their cards. The invention that started with a forgotten wallet had become the engine behind the largest consumer debt machine in human history. The concept of buying something now and paying for it later is ancient. Merchants in Mesopotamia extended credit to farmers thousands of years before anyone had electricity, let alone a plastic card. Shop owners in colonial America kept ledger books where customers ran tabs for months at a time. Even department stores in the early 1900s issued metal charge plates to loyal customers so they could buy clothes and furniture on store credit. These plates were clunky little metal tags, about the size of a dog tag, embossed with the customer's name and address. A clerk would place the plate in an imprinting machine at the register, press down, and create a paper record of the charge. It worked fine, but only at that one store. You could not take a Bloomingdale's charge plate to a hardware store down the street. Credit was personal, local, and limited. The idea of "I owe you" has been woven into commerce for as long as commerce has existed. But what McNamara stumbled into in that Manhattan restaurant was something fundamentally different. He did not want credit at one store. He wanted credit everywhere. In February of 1950, McNamara and his partner Ralph Schneider officially launched the Diners Club card. The concept was simple. Cardholders would present their card at participating restaurants. The restaurant would bill Diners Club, and Diners Club would bill the cardholder at the end of the month. The company took a 7% cut from the restaurant and charged the cardholder a $3 annual fee. The first batch of cards went out to about 200 people, mostly friends and business associates of McNamara, and they were accepted at 14 restaurants in New York City. 200 people, 14 restaurants. That was the entire credit card industry in 1950, and honestly, it almost died right there. Restaurants did not like giving up 7% of their revenue. Cardholders did not see why they needed a special card when cash worked fine. Diners Club lost money in its first year and nearly folded before it ever got off the ground. But McNamara kept pushing. He figured out that the card created a loop. The more cardholders he signed up, the more restaurants wanted to accept the card because those cardholders were customers walking through the door with money to spend. And the more restaurants accepted the card, the more people wanted to carry one. It was a network effect before anyone had a name for it. McNamara and Schneider started targeting salesmen and executives who traveled frequently, the kind of people who ate out 5 nights a week and hated carrying large amounts of cash in unfamiliar cities. For that crowd, the Diners Club card solved a real problem. And once those men started asking restaurants whether they accepted Diners Club, the restaurants had no choice but to sign up or lose business. By 1951, Diners Club had over 20,000 cardholders. By the mid-1950s, the card was accepted at restaurants, hotels, car rental agencies, and retail shops across the country, and even in parts of Europe. I mean, think about that for a second. A product that almost failed in its first year was suddenly reshaping how Americans ate dinner, booked hotel rooms, rented cars, and traveled for business. But Diners Club was still a charge card, not a credit card. The full balance was due every month. There was no option to carry a balance and pay interest. That distinction matters, because the real money in the credit card business, the kind of money that would turn banks into the most profitable institutions on earth, had not been unlocked yet. American Express noticed what Diners Club was doing and launched its own charge card in 1958. American Express already had massive name recognition from decades of selling travelers' checks and money orders. When they entered the credit card market, they brought a built-in customer base and a reputation for reliability that Diners Club could not match. Within a year, American Express had signed up over 500,000 cardholders, dwarfing Diners Club almost overnight. The American Express card carried prestige. It came with travel insurance and concierge services. It was marketed to executives and frequent travelers as a status symbol, not just a convenience. Carrying an American Express card told the world you were a certain kind of person. Successful, important, the kind of person who did not fumble around with cash. But the real turning point, the moment that cracked the industry wide open, did not come from New York. It came from a city in Central California that nobody was paying attention to. In September of 1958, Bank of America did something that had never been done before. They mailed 60,000 unsolicited Bank Americard credit cards to residents of Fresno, California. No application, no credit check, no permission, just a card in the mail with a $500 credit limit and a note explaining how to use it. The people of Fresno woke up one morning and found credit cards in their mailboxes, whether they had asked for them or not. Bank of America chose Fresno because it was a mid-sized city of about 250,000 people, where the bank already had a strong presence, and because it was isolated enough geographically that they could test the concept without it spreading to other markets before they were ready. The idea was to create instant critical mass. If enough people had the card and enough merchants accepted it, the network would sustain itself. No slow rollout, no waiting years for word of mouth. Just flood a city with cards and see what happens. The plan was bold. It was also a disaster. Fraud was rampant. People who had no business getting credit were suddenly spending money they did not have. Delinquency rates skyrocketed past 20%. Some customers used the cards and refused to pay. Others had their cards stolen from mailboxes before they even knew they had been sent one. Organized criminals figured out they could intercept the mail, activate the cards, and run up charges before the real recipients even realized what had happened. Bank of America lost millions of dollars in the first year of the Fresno drop. Internal reports described the launch as chaotic. Executives debated killing the program entirely, but Bank of America did not kill it. They adjusted. They tightened underwriting. They improved fraud detection. They started requiring merchants to call in for authorization on purchases above a certain amount. And they figured out the one thing that would separate the Bank Americard from every charge card that came before it: revolving credit. Instead of requiring customers to pay the full balance every month like Diners Club and American Express, Bank of America let customers carry a balance from month to month and pay interest on what they owed. Customers could pay as little as they wanted, as long as they met a small minimum payment, and the remaining balance would roll forward with interest charges added on top. This was the moment everything changed. The monthly interest on unpaid balances became a river of revenue that never stopped flowing. Customers loved it because they could buy things they could not afford right now and pay for them slowly over time. The bank loved it because every unpaid balance generated interest income month after month after month. If Frank McNamara had stopped at Diners Club, the credit card might have remained a niche convenience tool for business travelers. But revolving credit turned it into a financial product with almost unlimited profit potential. This one decision would look back on the rest of the credit card story, and its fingerprints would be everywhere. The Fresno drop worked well enough that Bank of America started licensing the Bank Americard to other banks across the country. The licensing model was clever. Other banks could issue cards under the Bank Americard name, tap into the merchant acceptance network, and share in the transaction processing. By the mid-1960s, dozens of banks were issuing their own versions of the card under the Bank Americard name. But the system was messy. Each bank ran its own operation with its own billing cycles, interest rates, and authorization procedures. There was no unified network for processing transactions or settling payments between banks. If you used a Bank Americard issued by a bank in Ohio at a store served by a bank in Texas, nobody really knew how to handle the paperwork. The system was held together with duct tape and phone calls, and it was buckling under its own weight. Enter D. Hock. In 1968, Bank of America brought together the banks that were licensing BankAmericard and asked them to form an independent organization to manage the network. D. Hock, a relatively unknown banker from Seattle with a reputation for unconventional thinking, was chosen to lead it. And what D. Hock built over the next several years was extraordinary. He believed the network should function like a living organism, decentralized but unified by common rules. He convinced hundreds of competing banks to join a single cooperative network where they would all play by the same rules and process transactions through the same system. He essentially got rivals to work together, which is one of the hardest things to do in any business. Banks that competed fiercely for customers in their home markets agreed to cooperate on the processing infrastructure that made the entire system function. In 1976, the BankAmericard network was renamed Visa, a name Hock chose because it was recognizable in virtually every language on Earth, and the brand that now processes more transactions than any other payment network on the planet was born. Meanwhile, a group of banks that had been left out of the BankAmericard licensing deal formed their own alliance, called the Interbank Card Association, which issued the MasterCharge card. By 1979, MasterCharge had rebranded to MasterCard, and the two-horse race that still defines the credit card industry was officially underway. Visa and MasterCard were not just competing for cardholders, they were competing for merchant acceptance, bank partnerships, and international expansion. Every gas station, grocery store, department store, and airport shop became a battleground. The network that got accepted in more places won more customers, and the network with more customers got accepted in more places. Same Loop McNamara, discovered in 1950, just operating at a global scale. Both companies poured money into marketing and sponsorship deals. Visa became the official payment partner of the Olympic Games starting in 1986. MasterCard countered by sponsoring the World Cup and launching its priceless advertising campaign, which became one of the most recognizable ad campaigns in history. The rivalry pushed both companies to expand aggressively into Asia, Latin America, and the Middle East, bringing credit cards to markets where cash had been the only option for centuries. By the early 2000s, Visa and MasterCard together controlled over 80% of the global credit card market outside of China, where the government had created its own national card network called UnionPay. But all of this growth would have stalled without a piece of technology so simple that you have probably never thought twice about it: the magnetic stripe. In the early days of credit cards, every transaction was processed by hand. The merchant would place the card in a manual imprinter, a heavy metal device that some people called a knuckle buster because of the force required to slide the handle. The imprinter pressed the card's raised numbers onto a carbon paper slip, creating a physical record of the transaction. The merchant kept one copy, gave one to the customer, and mailed the third to the bank for processing. Settlement could take days or even weeks. Fraud was nearly impossible to catch in real time because there was no way to verify the account status at the moment of sale. And the sheer volume of paper was overwhelming banks that were processing millions of transactions. An IBM engineer named Forrest Parry had been trying to attach a strip of magnetic tape to a plastic card so that information could be stored and read by a machine. The problem was that the glue kept melting when he tried to bond the tape to the card. According to the story that has been passed around for decades, Parry came home frustrated one night, and his wife, who was ironing clothes, suggested he try using the iron to melt the stripe onto the card. He did. It worked. And that kitchen experiment became the foundation of every credit card transaction for the next 40 years. The magnetic stripe let machines read account information instantly, which meant transactions could be authorized electronically instead of processed by hand days later. By the late 1970s and early 1980s, electronic point-of-sale terminals started showing up in stores across America. You swiped your card, the terminal dialed a phone number, the authorization computer checked your account and credit limit, and in a few seconds, the transaction was approved or declined. What used to take days now took seconds. The magnetic stripe turned credit cards from a slow, paper-heavy system into a fast, electronic one. This is where the story takes a turn nobody expected. Not in the technology, not in the business model, in the human brain. Researchers started noticing something odd about credit card spending in the 1980s and 1990s. People who paid with cards consistently spent more money than people who paid with cash. Not a little more, significantly more. A study at MIT had participants bid on sports tickets. One group was told they could only pay with cash. The other group was told they could only pay with credit card. The credit card group bid roughly twice as much for the same tickets. Same event, same people, same auction format. The only variable was the payment method, and the results were dramatic. Other studies replicated similar findings. Restaurant patrons tipped more when paying with card. Shoppers bought more items per trip. Even vending machine purchases increased when card readers were installed. Paying with cash activates a region of the brain associated with physical pain and loss. Handing over bills and watching your wallet get thinner creates a psychological friction that makes you think twice before spending. Swiping a card eliminates that friction almost entirely. The purchase feels abstract. The money does not feel real. You are not losing anything in the moment. The bill comes later, and by then, the pain of spending has been separated from the pleasure of buying by weeks. This is not a bug in the credit card system. It is a feature. The entire industry depends on the fact that you spend more when you do not see the money leaving your hands. And the credit card companies knew this. They built their entire marketing strategy around removing friction from the buying process. Faster checkout lines, tap-to-pay technology, one-click online ordering, rewards programs that made spending feel like earning. Cashback cards offered 1 or 2% of every purchase returned to the customer, which sounds like the bank is paying you to shop. Travel rewards cards dangled free flights and hotel stays, turning every cup of coffee and grocery run into progress toward a vacation. The psychology was brilliant. The rewards reframed spending as saving. Customers would actually spend more on their credit cards to earn rewards that were worth a fraction of what they spent. And the rise of online shopping in the late 1990s and 2000s made credit cards more essential than ever. You could not buy something on Amazon or book a hotel room online with cash. You needed a card number. The internet did not just expand where credit cards were used. It made them mandatory for an entire category of commerce that was growing faster than any other. Every innovation in credit card technology over the past 50 years has been designed to make spending easier, faster, and less painful. Which is great for the economy. More spending means more commerce, more jobs, more growth. But it also means more debt. And by the early 2000s, the debt numbers were getting hard to ignore. If you have been watching this far, do yourself a favor and hit subscribe. We cover stories like this every week, breaking down how money, business, and everyday products actually work behind the scenes. By 2003, total credit card debt in the United States had crossed $700 billion. By 2008, the year the global financial system nearly collapsed, it had climbed past $1 trillion. The average American with a credit card balance owed more than $8,000, and for many households, that number was far higher. Credit card interest rates, which averaged around 18% and could climb as high as 29% for customers with poor credit, meant that a $1,000 purchase paid off with minimum payments could end up costing $2,000 or even $3,000 by the time the balance was cleared. The minimum payment itself was designed to keep customers in debt as long as possible. Credit card companies typically set the minimum at around 2% of the balance, which meant customers were barely covering the interest charges each month and almost never touching the principal. And no, I am not making that up. The math is genuinely brutal. If you owe $5,000 at 20% interest and pay only the minimum each month, it takes over 22 years to pay off the balance, and you end up paying more than $7,000 in interest on top of the original $5,000. That is the kind of number that makes accountants cry. The banks understood this arithmetic better than anyone. Revolving credit was not just a convenience for customers, it was the single most profitable product in the history of retail banking. Late fees added another layer. In 2006 alone, the credit card industry collected over $17 billion in penalty fees from customers who missed payments or exceeded their credit limits. Over-limit fees, cash advance fees, balance transfer fees, foreign transaction fees, every possible interaction with the card had a fee attached to it, and the revenue kept stacking. The industry also discovered that college campuses were fertile ground. Throughout the 1990s and 2000s, credit card companies set up tables outside university dining halls and offered students free t-shirts, pizza, and frisbees in exchange for filling out credit card applications. These were 18 and 19-year-olds with no income, no credit history, and no understanding of compound interest. They were being handed credit cards with $1,000 limits and 20% interest rates in exchange for a slice of pepperoni pizza. By the time they graduated, many had racked up thousands of dollars in debt before they had even earned their first real paycheck. Congress eventually stepped in. The Credit Card Act of 2009 banned some of the most predatory practices, including issuing cards to anyone under 21 without a cosigner or proof of income, and required companies to disclose how long it would take to pay off a balance using minimum payments. But the damage had already been done for an entire generation of borrowers who entered adulthood already underwater. Through all of this, the technology kept evolving. The magnetic stripe that Forrest Parry glued to a card in his kitchen eventually became a security liability. The data on a magnetic stripe is static, meaning anyone who copies the stripe has all the information they need to make a fraudulent transaction. Skimming devices attached to ATMs and gas station pumps could read and clone magnetic stripe data in seconds. Criminals built entire operations around it. They would install tiny, nearly invisible devices over the card slot on an ATM, capture the stripe data from every card that passed through, and use that data to manufacture counterfeit cards. Credit card fraud cost the industry billions of dollars a year, and the magnetic stripe was the weakest link. The solution was already in use in Europe and much of the rest of the world. EMV chip technology, named after Europay, Mastercard, and Visa, embeds a tiny computer chip in the card that generates a unique transaction code for every purchase. Even if someone intercepts the data from a chip transaction, the code cannot be reused. It is a one-time key that expires the moment the transaction is completed. Chip cards had been standard in Europe since the early 2000s, but the United States was slow to adopt them. American banks and merchants argued over who would pay for the costly upgrade, and the magnetic stripe infrastructure was so deeply embedded in the system that switching felt like replacing the engine of a car while driving it on the highway. It was not until 2015 that the major card networks finally imposed a liability shift, meaning whichever party in a transaction, the merchant or the card issuer, had not upgraded to chip technology would be responsible for fraud losses. That deadline finally pushed most American retailers to install chip readers, years behind the rest of the world. And just as chip cards became standard, the industry was already moving past physical cards entirely. Apple launched Apple Pay in 2014, letting iPhone users load their credit cards into a digital wallet and pay by holding their phone near a contactless terminal. Google followed with Google Pay. Samsung launched Samsung Pay. Each of these systems used a technology called tokenization, which replaces the actual card number with a random token for every transaction, adding another layer of security on top of the chip. The experience of paying changed completely. Instead of reaching for a piece of plastic, pulling it from a wallet, and inserting it into a reader, you just held your phone near a terminal, and the payment happened in less than a second. No signature, no PIN, just a quick tap and a confirmation buzz. Retailers that had spent decades training cashiers to handle credit card transactions now had to rethink the entire checkout experience. Self-checkout lanes, mobile ordering apps, and subscription billing all accelerated the shift away from physical cards. The pandemic in 2020 pushed this even further. Stores that had never accepted contactless payments rushed to install terminals because customers did not want to touch anything. Contactless credit card transactions surged by by more than 150% during that year alone. The credit card started as a physical object, a piece of cardboard at first, then plastic with raised numbers, then a magnetic stripe, then a chip, and now it is becoming invisible. A string of encrypted data stored on your phone. You do not swipe, insert, or even tap a card anymore. You tap your phone, or your watch, or you just check out online and your browser auto-fills everything for you without a second thought. The physical credit card, the thing that Frank McNamara inspired in 1950, is slowly disappearing, but the system behind it is more dominant than ever. In 2023, global credit card transaction volume exceeded $40 trillion. Visa alone processed over $13 trillion in total payment volume that year, across more than 130 million merchant locations in over 200 countries. Those are numbers that would have been incomprehensible to Frank McNamara, sitting in that Manhattan restaurant, embarrassed because he forgot his wallet. And the evolution is not slowing down. Buy now, pay. Later services from companies like Affirm and Klarna have emerged as a new form of credit that competes directly with traditional credit cards, offering installment plans at the point of sale with lower or zero interest. Cryptocurrency advocates have pushed for decentralized payment systems that bypass the card networks entirely. Central banks around the world are exploring digital currencies that could theoretically make credit cards obsolete. But credit cards have survived every challenger for 75 years and counting. They survived checks. They survived debit cards. They survived PayPal. They are currently surviving crypto and buy now, pay later. The network effects that Frank McNamara stumbled onto in 1950, the loop of more cardholders creating more merchant acceptance, creating more cardholders, have proven almost impossible to break. The credit card made modern consumer life possible. It built the infrastructure for online shopping, enabled seamless international travel, gave millions of people access to emergency funds when they needed them most, and created a credit scoring system that determines whether you can buy a house, rent an apartment, or even get a job. Think about that. A number generated largely from your credit card payment history now affects whether a landlord will give you a lease or whether a bank will approve your mortgage. The credit card did not just change how we pay for things. It created an entire system for judging financial trustworthiness, one that follows you for your entire adult life. At the same time, credit cards buried millions of families under mountains of high-interest debt, turned spending into a psychological trick where the pain disappears but the bill does not, and made banks richer than they had ever imagined possible. Frank McNamara sold his stake in Diners Club in 1952 for a reported $200,000. He died in 1957 at the age of 40, never knowing that the embarrassing dinner he had in 1949 would reshape the global economy. Ralph Schneider continued running Diners Club until it was eventually overtaken by Visa and Mastercard. The original Diners Club card, the one that started it all, still exists as a brand, though it is now owned by Discover Financial Services and accounts for a tiny fraction of the global credit card market. The card that came from a forgotten wallet in a Manhattan restaurant now processes trillions of dollars every year, sits in the pockets and phones of billions of people on every continent, and has become so embedded in daily life that trying to rent a car or book a hotel without one is nearly impossible. A small piece of plastic, smaller than your hand, changed how the entire world buys, borrows, and owes. That is what the credit card left behind, and that story is still being written. If this video gave you a new way of thinking about the card in your wallet, hit subscribe and leave a comment telling us what financial topic you want us to cover next.